Amit Khurana as well joins in on the show right now. Amit, hi, good morning. Good to have you on the show. Can't help but start off by asking you what explains the sell-off, if I can use that term, in the market yesterday, Amit.
Well, you can ascribe as many reasons as we wish it to be. I think it's largely a realignment of the FPI portfolios. That's one prime reason. We are seeing, some bit of, India weightages getting realigned by the long-only global funds. That's one. And second, of course, you've also seen some of the, domestic HNI investors beg you to take money off the table. While it doesn't reflect very aggressively on the data side on the derivatives as we track actively, but I think we've largely seen the buzz has been that people are taking money off the table. So I think largely the direction remains as we were anticipating, and hopefully we should probably get over this corrective sooner than later.
Hoping it's sooner rather than later as far as this corrective phase getting over is concerned. But Amit, let's put the spotlight on a couple of earnings. And from the NBFC world, we got a couple of earnings overnight, Bajaj Finance as well as M&M Financial, and both were on the weaker side. For Bajaj Finance, they've talked about how credit cost is likely to be higher, and M&M has gone ahead, or M&M Financial has gone ahead and cut their guidance for a return on asset ratio. What's your take on the two?
Well, we don't have official ratings on those two names in particular, but I think the larger narrative of higher credit costs has been our base case for FY25. And this you're seeing it not just in NBFCs, but larger bank space also. Last year was a very big benefit to all the financial sector players because the write-backs took care of the profit growth. But this year, the credit cost normalization is playing out. In fact, we believe that some of the pockets are in much higher stress than what the general consensus seems to be assuming, especially the MFI space now where we're seeing some of the companies reporting much higher stress levels. And also, I think over the next couple of quarters, you have to be prepared for even the secured book facing a bit of a stress, including the NBFC book, which I think market will have to then realign its expectations on how the valuations and the overall trajectory of the quality of the book will play out. So not surprised by their guidance. And I think there is still some more next quarter or two of likely pain, which could play out for the sector at large.
Right. We were just looking at, Amit, the list of PSUs and the kind of fall that they've had from their 52-week highs. And I'm just talking about banks in specific, from a Union Bank, which has fallen more than 36%, to Punjab National Bank, which is 33.5%. Even SBI, for that matter, has had a fall of nearly about 13.5% from its 52-week peaks. Ex-banks, of course, the list is even more painful. I mean, you've got a Mishra Dhatu, 38% fall, New India Assurance, IRFC, ITI, MMTC, MRPL. 49% is the kind of fall that some of these stocks also have had. Once the correction in the market seems to be over, would you be a buyer in any of the PSUs and ex-defense and railways?
Yeah, I think it's difficult to paint all PSUs in the same color. I think what is happening is a realignment of the valuations. PSUs had a fabulous run over the last 12 to 15 months. And while we are quoting the declines that we have seen in the prices, remember some of these names have quadrupled, tripled in the last 12 to 18 months. So it's par for the course to have those kind of correctives. Also, let us not forget that some of these PSUs were now quoting at valuations which were at par with the best-in-class even private sector banks. For example, banks that you highlighted, some of the PSU banks were now quoting at price to books of 1.2, 1.3 for ROAs, which was still sub 1. And FY24 earnings were guided significantly by the write-backs, which I highlighted. But the credit cost normalization for 25 and possible elevation for 26 is leading to a reality check in the market, and therefore these corrections are playing out. For the other sectors, other than the banks, I think the valuations were pretty rich and priced to perfection. So the case to build up further returns was becoming a challenge, and we've been holding this view since Q1 earnings. It's just that it has taken its own sweet time to show up in terms of the market realizing that these are pretty elevated valuations, and therefore the corrections are now taking place. But our view on PSU banks, even from Q1, has been more of caution and of the assumption that best of the valuations are in the price, and therefore one needs to be a little bit more careful in terms of allocations to PSU stocks at particular and banks, so to say.
Okay, so yes, valuations were punchy, and that's the case with a large part of the market as well. But which are the other stocks which are going to be in news today? Let me hand it over to Snehi to get that list.
Well, yes, good morning. Here's a list of all the stocks to watch out for in today's trade. First up, on the back of Q2 earnings, watch out for Persistent Systems. It's been a steady set of numbers this time. Dollar revenue growth was up 5.3% sequentially as well. Coforge also watch out for a good set of numbers, but margins were slightly impacted this time coming around. M&M Finance, however, weak set of numbers coming in. They've cut their ROA guidance as well to 1.8 to 2% for FY25 compared to the 2.2 to 2.5% range earlier. Indus Towers, however, strong set of numbers coming in. PAT is up 71.7% year on year. Margins have also expanded to 67.3% compared to 49.8% on a year on year basis. But moving away from earnings, let's talk about a couple of stocks that will be in focus on the back of order wins today. RITES will be one of these stocks. It has secured a turnkey project worth 454 crores. So it's a big order win coming in for RITES this morning. Power Grid has also backed two transmission projects in Rajasthan. They've also approved to raise 5,000 crores via bonds in their board meeting yesterday. Also watch out for Sonata Software. The company has received a multi-year AI-powered managed services contract as well. Next up, watch out for Big Boy Reliance in today's trade. The Competition Commission of India, which is the CCI, has approved the merger between Reliance and Disney subject to certain modifications. One key modification here is that there will be no bundling of TV ad slots for IPL, ICC as well as BCCI cricketing rights until the current rights agreement expires. Also from agencies, we understand that IDBI Bank will be in focus today because the government is moving ahead with the disinvestment process of IDBI Bank. IDBI Bank's bidders' due diligence will start in November, and financial bids for the strategic sale are likely to come in by Q4 of this financial year. Lastly, on the back of some corporate action, watch out for KPIT Tech because along with its earnings today, the board is also going to be mulling fundraising plans. So watch out for any announcements on that front. But while yes, keep a close eye on all of these stocks in today's trade.
Okay, bunch of these stocks which are going to be in focus. But Amit, outside of the list of PSUs, where is it that you would be a buyer in the current fall? What are the themes that are looking interesting after some amount of valuation has eased off from the top?
Well, we've been very, very stock specific, very bottoms up over the last quarter and a half. And I think the pockets of opportunity that we find are more on the consumption side, especially domestic consumption, which is what we've been calling out since May. We believe there is a genuine turnaround happening on domestic consumption. And even though one may see pockets of stress emerging in some variable or the other, but we believe that rural is beginning to perform much better. So some of those related franchises what interests us at this point of time. And some of these names have also corrected in this, in this market overall correction. So that's something that we're very much interested in. Now, discretionary has been a mixed bag for us, but we are playing very stock specific, especially in the festival demand, wherein it has been a slow start. But our sense is that it is eventually picking up and should be a reasonably good festival season and the wedding season demand, which works out after the Diwali festival season is done. So overall, domestic consumption as a theme is what we've been backing up with. And beyond that, I think rather than the sectoral weightages, it's been more focused on the merit of the individual franchise, individual stock that we are going around with. And we believe over the next 12 months, this will be a more dominant theme to manage portfolios rather than just the sectoral weightages.
So that's the view coming in. The consumption, of course, hasn't really picked up so far in the festive season. Let's see what the way forward is likely to be. Naresh, wanted to get you in on some of these IT companies. Mid-cap IT names reported earnings. Persistent was a good set. The revenue growth came in at 5.5% thereabouts. Zensar was better than expected because they'd already highlighted it's going to be a weak Q2. They've managed to deliver a 1.2% growth nonetheless with a bit of a margin expansion. And for Coforge, the numbers were boosted by the Cigniti integration. But barring that, while the sequential organic growth has been good in terms of revenue, the margins were a bit of a mixed bag. What's your take on these three IT mid-cap companies, Suresh?
So out of these names, Zensar looks the most interesting because if you look at the consolidation which it has gone through, the stock topped out at 550, 580 back in 2021 with the whole IT names, went back to 250 to 200 levels, came back to 550, 600. Consolidated there, and then we saw this move to 800 plus. So out here, 600 has been a strong 600, 650 has been a strong somewhat. The last breakout point also was here. Yesterday, the stock came back and retested those levels. So from these levels, there is still an upside because the stock is up. Stock is down 15-20% from the peak. So there could be upside from here on. At the same time, Persistent has actually done really well over the last even post 2021, one of the only stocks which is up more than 150% from the highs of 2021. Even in the recent times, the stock has done really well. So even after the good reaction to numbers, the stock could have possibly made the top at around that 5,500, 5,700 mark. Coforge would again wait it out. The stock still looks interesting, but 6,000 to 6,400 is a very strong support for the stock.
Amit, there is a long list of stocks which are down more than 30%, and there is even a longer list of stocks which are down more than 25%. In that long list, really long list of stocks which are down 20 to 30% or 30 to 40%, where are you likely to pick your spot where you would say, I would filter out the noise, I will not look at China, I would ignore what the situation on the crude is, but I would buy those stocks. Which are those stocks which you always wanted to buy now that Flipkart or Amazon Diwali sale is around the corner? अमित खुराना, भाई आप ही ऐसा जवाब दे सकते हो. No, you cannot hear me. I called out your name, my friend, 3 times. You've started ignoring my voice also now. I know we've not kept in touch, but that doesn't mean you don't recognize old friends.
Happy Diwali.
By the way, I just want to tell our viewers that we are very good friends. How's your daughter, Amit?
He's doing well. I have a son.
See, you don't keep in touch now. We've known Amit for what, 20 years now?
You keep a count.
Okay. It was so nice to...
So to come to the question, the big picture is that rather than looking, as I said earlier, on the corrections that have happened on franchises, look at the merit of each of the franchises. So domestic consumption, definitely I would be buyer. Larger banks, which have a lower risk of a stress, especially on the secured book, would be ones which we would look out for. So that takes out the PSU banks out of this equation and look out for the larger private sector banks. So that would be another pocket to look out for. Now, having said that, I think discretionary, as I said, has shown some mixed trends, but largely you would expect a better festival performance, and a strong wedding season should play out favorably for even the discretionary plays. So you have the typical durables, that would be one of the favors. Autos at a certain valuation, one would be looking to look at those as well. And as also the jewelry segment. Now, we did find some evidence wherein Titan was facing some pretty aggressive competition from the local franchises. But I guess as the season picks up and with the gold prices, the way they are behaving, should possibly lead to some opportunities in some of these segments. So the big picture is watch out for individual stocks. Once you like them, buy it at a certain price, and then you have to be prepared for realistic return scenarios and not build in very, very aggressive return expectations. I think this market will give us some more time correction as we go along, and possibly one will have to be very patient with the way things are going to be over the next 6 to 12 months. You have a lot of developments at the global front also, which will keep us on our toes as to how those work out.
Point taken. That's the view coming in. Kunal, wanted your take regarding a couple of these stocks. ICICI Pru Life, wherein the VNB has come in higher than estimates. Seems like growth has bottomed out. At least that is what HSBC is saying. And the other one I wanted your take on is Max Financial. Looks like it's a good set.
In fact, both of these charts. So, in fact, many of these insurance stocks have been actually very strong or relatively strong as compared to many of the other sectors. Now, I think ICICI Pru, for example, the stock has been trading into a range. It's managed to, just about go into a time-wise consolidation. 725, 720 seems to be a support, and 760, 770 seems to be a resistance. The stock was looking, closer towards a breakout that 760, 770 mark, but because of yesterday's price action on the markets overall, we saw the stock coming back into the lower end of this very tight range the stock is trading into. So I would still believe that the stock is, quite strong, and when stocks show relative strength in one of the toughest times of the markets, I think these are the kind of stocks which generally show the first signs of a breakout when the market gets into a revival or an uptrending mode. Same is the case with Max Financial Services. I think the stock, which had been a late starter as compared to many of the other peers, when it moved from I think 930, 940 towards 1100 plus mark. Recently also the stock has shown very good price volume momentum. We've seen the stock making a pattern of higher supports, higher lows for itself on a medium term basis. So again, looks like a strong chart. The near term support for Max Financial is closer to 1125.
Vodafone has gone from 20 rupees to 8.5 rupees. Amit Khurana, there is a fundamental push for Vodafone, which is that they've raised capital. pricing power is coming back. At 8.5 rupees, purely based on fundamentals, how is Vodafone looking? Is the risk-reward ratio favorable?
It could be. At the price that you mentioned, it turns out to be favorable. But whether it is one of our preferred bets, no. We are still playing Bharti as one of the preferred ones. In fact, Bharti at these valuations also seem pretty reasonably well valued for price perfection. But yes, I think the bigger challenge is while the pricing power is coming back and you have so many other positives going for the sector, but the bigger issue for Vodafone as a franchise is the capex that they will have to keep doing relentlessly and be in the market, to be in a valid competitive state to compete with the other two big players. So at a certain price, yeah, it makes sense, but the expected returns will not be as strong or not as quick as one would wish it to be. Our blue sky scenario worked out to somewhere closer to 16 to 18 rupees.
The group which took a hard knock yesterday, Amit, was real estate. From DLF to Shobha to Max, every real estate stock, even Aditya Birla real estate, 7-8% lower. Now the real estate cycle is in a strong groove. That is what the indications are. While slowdown may have hit, let's say, autos, slowdown may have hit other categories of consumers, real estate is still standing tall. Is it a good time to buy the decline into real estate stocks to your advantage? Amit?
Yes, selectively again, but please understand that the first part, which is demand-led, cycle uptrend, is possibly more or less done. I think what you're going to see from here is relative performance between the stocks, diverging very materially. So franchises which have launch pipeline, which is far more visible and elongated, will possibly get more premium valuations, and that is where I think the differentiation part will work out. Remember, in the last 18-24 months, every real estate stock worth its name has moved pretty significantly. From here onwards, which is, I think, the second phase of this upcycle, will be far more selective. And therefore, one will have to accordingly align to names which have better visibility and a longer cyclical play. The cycle typically lasts between 4 to 6 years. We're probably in the between the third and the fourth year as we speak. So the second phase will possibly distinguish far more decisively between the franchises, which will do a better performance. But yes, the declines will offer an opportunity to buy into real estate as one of the packs.
Okay. I want to go back to defense stocks here, and what a crack it's been for defense and railways. Now, the big picture is government capex, the big picture is order book, the big picture is that Indian government would be spending more in terms of Indianization. So, the theme of buying these stocks because Indian government would be spending more in the entire defense space, I think that still holds true. The stocks had run up. You can talk about a coincidence that every time when sectoral funds they come, these stocks, they tend to bottom, peak out. That's exactly what happened. HDFC Defense Fund came, Motilal Oswal Defense Fund comes, and then these stocks, they peak out. How would you separate the men from the boys, Amit, in the defense space?
That's an easy one to make, because you've got to essentially look at two parameters. What is the visibility of earnings and how secure is the order book in terms of receivable cycle and delivery cycle? I think those are the two parameters that we typically track much more actively. And then pay a fair valuation, because some of these defense stocks had gone to levels which are quite unrealistic and building in implied assumptions which are quite crazy, so to say the least. And therefore, a reality check has come in, and some of these levels may attract some interest. And so will we also keep a watch on these and accordingly take a view. So to answer your question, defense remains a structural theme for India, but I guess you've got to look at the valuations in sync to figure out where to allocate the capital.
Amit, I just wanted to get a better sense from you regarding the manufacturing sector as well. Of course, that one was doing very well for itself. Then there was a bit of a flattening. From here on, what's the expectation? Because if you do assume that Trump is going to come back as far as US is concerned, there could be that trade war that might start, and that might just mean that the export-oriented companies might not do as well. With that context in mind, what do you make of the manufacturing sector?
Well, now one can make arguments both the sides. If Trump does get elected as a president, obviously tariffs are going to be triggered on China as per the political statement that they've been highlighting, and so on other countries. So while it will be a challenge for export-oriented, some of the manufacturing entities working from India, but obviously it could also present a significant opportunity wherein China companies could be impacted far more significantly than what the Indian companies will be, because the political statement seems to be a much higher duty tariff on Chinese manufacturers than other global manufacturers. So the argument could work in that sense also, that it presents an opportunity for us. But I guess we will have to wait and see about the outcome of the US election, as it seems to be pretty close. But the odds seem to be favorably moving in favor of Trump winning the election. But we have to see. So I would probably reserve my judgment and wait for the outcome, and then see how the political decision making happens, and accordingly, position the portfolio from Indian company perspective.
Amit, give me a stock or maybe two stocks or maybe three where you would say that you would like to allocate within these three stocks. Large cap, mid cap, small cap, doesn't matter what the market cap representation is. But in these three stocks, you would like to build up, let's say, 20% of your portfolio.
Well, one of the names we were discussing earlier was City Union Bank. It's one of the rare upgrades which has happened in financial space from our coverage universe and overall in the earnings till now, because till now the overall downgrade to upgrade ratio is pretty poor. I mean, we've had more downgrades than upgrades in the season, and City Union stood out as one of the rare cases where we had an upgrade to the rating, and we feel that it stands out as one of the better franchises for the next 12 to 18 months. So that's one name one can look at. Second, I think Paytm numbers and the overall overhang from the regulatory side seems to be waning off, and much better visibility over the next few months. And so that's another one that we believe is worth a look at. The stock may have its own yo-yo moment. Market will absorb the loss provision that they built in its own way, but we guess it's better conveyed in a pretty transparent manner rather than keeping the market on tenterhooks. So I think that takes away one of the critical elements which the market was concerned. And the approval from the NPCI yesterday, the permission is granted again for fresh onboards on the UPI side. So regulatory issues are waning off, and eventually, as the profitability becomes more and more visible, I guess this could be in for some good times from here on. So these are the two names that I would like to highlight from the earnings that have been released. For those which are not, I would probably reserve my judgment.
Okay, reserving your judgment there, but thanks so much for joining us for the rest of the chat. Thanks, Amit, for making time for us. But
there comes a time when your heart calls for you to arise. Plant your feet solid into the ground. Decide your own limits, and then break right through them. Become something more. It's my time to rise.